Welcome back to the Quant Course Academy. My name is Sarjoghian, and this video is the 5th edition of the Option Strategy series. In this video, I am going to talk about the bullish strategies using put options. Stay tuned. Looking to profit in a rising market without buying the stock outright? Let's explore bullish put strategies that can work wonders for your portfolio. Today, I'm going to talk about 3 different strategies that will help beginner and intermediate traders to profit when the market forecast is going to be bullish. In this video, you are going to learn 3 different strategies which are selling or writing a put, bold put spread, and married put. Now let's talk briefly about what's the use of each and every one of them. First, selling a put or writing a put. Selling a put to collect a premium, assuming the stock price will stay above the strike price. Second strategy, bold put spread. A defined risk strategy involves selling a put and buying a lower strike put. And the last one, married put. A married put involves buying the stock and simultaneously purchasing a put option as an insurance. It protects your downside risk while keeping your upside potential intact. Now let's talk about the benefits of the bullish put strategies. Traders usually incorporate the bullish put strategies to generate income from premiums, lower risk alternative to buying a stock, can profit even if the stock stays flat or slightly rises, protect their actual investment and portfolio in event that the market declines. Now let's go through an example for every one of them. First, let me give you an example for the selling or writing a put. Let's say the Apple stock is trading at 250 and you are predicting the market is bullish, which means the price of the stock is expected to rise due to the market condition or introduction of the new device. Now, as a result, you might sell a 250 put and collect $5 premium. If the market starts to rise or even stay flat and above 250, then at the time of the expiry, you keep the $5 premium. But if the market drops to 240 at the time of the expiry, your loss would be the price which you entered the contract minus the price at the time of the expiry of the contract minus the premium that you received at the time of the contract. Now let's create the bold put spread scenario. Let's say you sell a $240 put for $5 premium and buy a 240 put for $2. Your net credit would be $3. If the market at the time of the expiry stays above 250, then you keep the premium and contract expires worthless. But if the market drops to below 240, then your loss would be the price of the selling the put at the time of the contract minus the price of the put that you bought at the time of the contract. So in this case, 250 minus 240 minus the premium that you received, that was $300. So your total loss as follows. 250 minus 240 minus 3 equals 7 multiplied by 100 shares. Since every contract contained 100 shares, then your debt would be equal to $700. Now let's talk about the risk for these two strategies. For sell or writing the put option, the traders expose themselves to the unlimited downside risk without any protection, and the loss could be significant. But for the bull put spread, the risk is defined and limited to the spread, which is the difference between the two prices for the selling and buying back the put. Okay, so far we talked about 2 powerful strategies that you might have a benefit from. Now let's talk about the last strategy that I would say most likely traders and the professionals uses, that as a protection for hedging their investment or their entire portfolio. In other words, the traders incorporate this strategy when they are bullish on the actual stock but looking for protection against a sudden drop in the price. This strategy called married put. Now let's talk about the married put benefits. First, protects your investment from significant losses. Second, this strategy offers peace of mind during the volatile market conditions. Third, ensures you can sell the stock at the put strike price if the market moves against you. And the last one, unlike selling a put, the married put requires an upfront cost, which is the premium, but it provides full downside protection for the investors. Okay, now let me explain that through an example. Let's say the Apple is trading at $250. You buy 100 shares of Apple at $250. To protect against downside risk, you buy $245 put options for $3. The cost of trade would be $25,000 for 100 shares plus $300 premium for buying the put. The total will be $25,300. The protection. If Apple drops below $245, you have the right to practice your put options at $245, capping your maximum loss. Upside potential. If Apple rises above $250, your profits are unlimited, minus the $300 premium that you paid for the put options that you purchase as an insurance. If Apple rises to $260, your profit would be $260 minus $250 multiplied by 100 shares minus 300 premium equals $700. If Apple falls to $240, your loss would be $250 minus $245 multiplied by 100 shares plus 300 premium equals $800. Basically, this strategy acts like an insurance for your stock positions. Now let's talk about the risk and rewards. Okay, risk. Limited to the cost of the stock minus the put's strike price plus the premium paid. But the reward? Unlimited upside to the stock appreciation minus the premium cost. Compared with the risk and the other strategies such as the unlimited downside risk of the short put or the defined risk of the bold put spread. So you might ask when to use married puts. Use when you expect a significant stock appreciation but want protection from the sharp declines. Also, this strategy is ideal for the volatile stock or uncertainty market. And remember, consider long-term puts to reduce the impact of the time decay if you plan to hold the stock. Okay, let's go over the three strategies one more time for their purpose of use. First, short put for generating income in the stable to rise market. Second, bold put spread for the lower risk income strategy with a defined risk. And the third, married put for downside protection while maintaining the upside potential. Now we got to the conclusion point of this video, and let me ask you, which one of these strategies will you try next? Comment below and share your thoughts. If you found this video helpful, please like, subscribe and share. Let us know in the comments which strategy you would like us to cover next, and thanks for watching.